Real mortgage questions. AI answers. One broker who tells you what it actually means. I'm Edward Brady, a chartered financial analyst and broker at eXp Realty. Opinions are my own and not that of eXp Realty, its management or staff. This is Mortgage Questions. Let's get into it.
This is an interesting subject because I know some people that got in trouble with these, and that is fixed versus adjustable rate loans. Loans are usually framed as stability versus flexibility. And how do you match loan structure and how long someone plans to stay in the home?
Great question. And this pairs well with a lot of people who are relocating, right? Because maybe work or other timelines. And I would say if you're looking to stay somewhere because you want to be around family or work, and you're not going to be doing a lot of moving in the next 4 to 7 years, something that's more fixed, something more stable would work for you. And a lot of the times it helps because you're going to know that your payment is going to be consistent over that typically 30-year period that people get for their loans.
That makes sense. So I said before that I knew a couple of people that got into trouble with ARMs. And so in your expert opinion, what is a method to avoiding the teaser price where the payment skyrockets?
So it might not make sense if someone's staying long-term versus short-term. You don't want that teaser payment or that initial payment where it's lower the first 5, 7, 10 years to bite you in the butt is later having that adjust. Oh, no, just something I might say where you're used to that short payment, but you're staying in that home in that area for a longer term, right? So we want to make sure that it's going in unison with whatever that timeline is. A great one is you're getting used to and accustomed to that payment. And later on, we're in a higher rate environment if someone bought a few years ago, and then it just where it significantly increases their monthly payment. Now they have to adjust to that new payment and they're going to have maybe that payment shock. That's something we want to try to mitigate, right? So if someone is only going to be in a certain place temporarily in a fixed amount of time, that's where I do things a little bit differently of having a financial review with someone and making sure that nothing is changing with that timeline. If they're there for 4 years or 5 years, maybe we cushion, if we know they're there for 4 years, getting a 5-year term, just in case something happens in the delay of moving. So they're still cushioning and knowing that's still the target timeline of being in a certain place. And so maybe having that adjustable rate there for that 5-year term might be better for them. Or let's just say life happens where they need to extend their time there. We could look at now seeing, okay, is it longer where it's maybe makes sense to have a 30-year term? Or is it where we just need to extend out to maybe another 5-year term or a 7-year term? So we want to consistently be in touch with our clients, making sure that the financing is working for them with their time horizon.
Amortization is a very technical term, but I wanted to talk about that a little bit and just when does it become a problem and who should not touch these types of loans?
So a great question, because of a lot of bad outcomes a few years, a good while ago during 08 era. A lot of these negative amortization loans are not in existence today. A lot of it was just the unawareness of how they worked and how when your payment is adding on, and so it's not really amortizing positively, right? A lot of people were not aware of how these loans were structured, right? And forgive me, I wasn't really in the business back in the day, and just from past experience and a lot of hardships that came from that, a lot of people weren't able to afford these homes, right? They weren't really paying off the mortgage itself. And just from being in the industry now, a lot of these loans are structured where it's not negatively amortizing. It's in a way where it's amortizing properly, where you're going to be paying off your principal and interest over whatever term you're looking to get. And understanding that it's helping you grow your equity, right? It's not going to take from that equity that you're going to be hopefully getting from living in the property over time.
Okay. So instead of negative amortization, now they have either rate or payment cap.
So a lot of the times for a lot of your normal traditional loans that you're going to be purchasing a home with, it's going to be a regular amortized loan based off anywhere from a 30-year period is typically what people get. You'll get sometimes shorter terms, 20-year terms or 15-year terms, but you're not seeing a lot of these negative amortizations. Now, when we're looking at something that's like a construction loan, that's a little bit different structuring. That's for a different type of buyer and use case scenario. But for first-time home buyers, you're not going to see a lot of negative amortization loans.
So I guess I'm not clear on how that's working. So because if you don't have a negative amortization, then if the rate rises, because you have an ARM, let's say, and there's no payment cap, doesn't that mean your payment goes way up?
I think we're thinking about two different things. So yes, the negative amortization is typically when your payment continues to increase. So, if you're...
Oh, no, your principal increases.
Correct. Now, when you're talking about adjustable rates, the payment will stay fixed for a certain amount of time, whatever that term is. So it's like a 5, 7, or 10-year term typically. And then it will adjust to what the market rate is. So it will take into consideration, let's say right now, it's anywhere from high 5s to mid 6s, what that total payment will be, and it'll adjust now to that interest rate. So what that looks like is that it's still going to pay off some of your principal, mostly your interest in the first half of your loan term, but it'll have that shorter, more favorable rate of what you started on, let's say that 5-year term. Let's just say, for example, we'll do easy numbers. So if rates are around 6% right now, maybe it'll be half of that, right? For the first 5 years. And then now at that 6-year term, it will adjust to whatever that future rate will be. If it's still, hopefully not, at around 6%, it will be at that 6%. Or it could be lower if the market in the near future will be at a lower rate. But it will still take away and pay down some of that principal and interest. It's just your payment that you're going to be having is a lot shorter in the beginning stages of that 5-year period. And then later, because maybe interest rates are higher than what that teaser rate is, it'll be a little bit higher, just depending on what that future market rate is.
Let's say interest rates rise a lot, then it would be a lot higher, but the payment increases basically.
Correct.
Because